All right, what is up, traders? What's up, tycoons? Lots to talk about in today's video. And yes, we officially just had the worst day in the stock market. Now, what do I mean by that? Well, this is the S&P 500 average performance per day, and October 19th is historically the worst day in the stock market. So, you can see the average is negative 0.51%. All right. And that's what we mean by the worst day in stock market history. So hopefully the worst is behind us. We'll have to really see. We're going to break down lots of data, talk about new lows and new highs in the market. We're going to talk about jobless claims. We're going to talk about spending, the consumer, all right, as well as different savings, metrics and rates. All right, we'll take a look at short flows, and how potentially those short flows may have been a little bit too aggressive. And then we'll talk about basically some end of year seasonality and the potential for an end of year rally. All right, we'll talk about margins. And then we're going to dive into a little bit about AI and break down some, charts that we're looking at, okay? Whether it's the S&P 500, TLT, the 10-year treasury, gold futures, and also the dollar and oil. We're going to take a quick glance at all of those and just give you guys my thoughts and opinions. So be sure to smash the like button and subscribe to the channel for more. And as always, the content provided on this channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. So please be sure to read through the disclaimer. If you're new to the channel and not familiar, I started a completely free newsletter for you guys called Investment Intelligence, giving out free, valuable finance content, as well as I try to sprinkle in some free trade ideas every single week. This was one on Tesla over a month ago, and you can see how that trade played out. This is also SWK, Stanley Black & Decker, and just highlighting some of the conditions that we're looking at in these potential trade setups. And you can see that both of those trade setups played out very nicely. So if you're fans of free, valuable content and free trade ideas, you can sign up for the newsletter using the link in the description and get those sent straight to your inbox. And if you ever want to book a one-on-one session with me where you can figure out how we structure some of these trades and the different type of setups that I look at, okay, you can reach out to me via Ko-Fi. Click on the commissions page here, and this is where you can book your 30-minute or 1-hour sessions. I do those one-on-one sessions all the time, and you can also request a YouTube video directly through this Ko-Fi platform. Again, the link for both of those is in the description. Let's go ahead and get into the video. And so we talked about October 19th being the worst day in the stock market. What I really want to highlight is if you take a look at the days in November, okay, the days in November look pretty good, as well as December. Now, they may not be record-breaking numbers, okay, but moving forward, November and December look pretty good for the market on your average returns per day. Now, currently, the market has been in a downtrend and new lows have exceeded new highs for 9 weeks and counting, and the new low list continues to expand. New lows last week climbed to their highest level since the S&P 500 was bottoming in October of 2022. So is this a bottoming signal, or is this potentially a sign that the market has more to sell off? Now, Warren notices basically suggests that jobless claims will jump this month. Now, when you start to see the unemployment rate really start to spike, that's a bad sign for the market. Okay, now I'm not sure who Warren is or what this company is, but their data basically is suggesting that we're going to see this large jump in the jobless claims. And once you start to see the unemployment rate rise in a very rapid rate, right? And if this is true and we start to see unemployment really start to rise aggressively, that's a big warning sign, right? And also a big sign of a potential recession coming in the future. So we'll have to monitor how this is actually going to play out. And that's definitely something you want to pay attention to. Total spending in October decreased 11.9%. October is starting off weaker than September, which was already down 10.8% and down 10.9% ex food, the weakest month of the year so far. And this is a graph looking at all sectors ranked best to worst on a basis point change in the October first week versus September week. And you can see here, electronics, cosmetics, pets, home improvement, food retail, and eyewear. Those are really the only positives. Everything else is going down. You have jewelry, sporting goods stores, the mass dollar and off price, home and furnishing, apparel, footwear, department stores. All of those were down. Now, consumers are on a strong footing with between 400 billion and 1.3 trillion in excess savings that they can draw upon as the economy moves back toward price stability amid tightening financial conditions. Okay, and so in red, you have the real saving trend here, and then you have some different versions of, saving right here. So you have the rate trend in yellow, you have the rate average for real income in green, you have the rate trend for nominal income in this lighter blue, and then you have the nominal saving trend in this little bit of darker blue here. But, in my opinion, we don't really have as much excess savings as this would suggest. Okay. And if you take a look, nearly half of the $400 billion in excess savings was held by the top 25% income earners, with 191 billion by the end of August. The bottom 50% accounted for only 20% of total savings surplus. So, of course, the elite and wealthy are always going to have, a lot more money and a lot more savings. And I think that that is skewing a little bit of the data, right? While savings rate in the US are now below the pre-COVID levels, saving rates in other areas of the world have increased. So this is a little bit of a better chart in my opinion. And, really what we're seeing, again, is that the saving rates are below pre-COVID levels. And we've had lots of inflation since, COVID and as a result of the pandemic. So, you're going to want to take that stuff into account. And, I think that this shows you a little bit more than that first chart that we did, speaking about, the consumers really being on such a strong footing. Now, cumulative short flows across U.S. equities reached a fresh year-to-date high on Friday. Now, this is via October 6th, and we only started to see covers mainly via macro products yesterday. So keep in mind, this data is from October 6th, and we've continued to see the stock market actually go lower from there. After we saw these cumulative short flows reach a fresh year-to-date high. So that's what we're looking at on the right, the cumulative short flow. So as this goes up, you're seeing the shorts increasing, okay? And then you have the macro products here in blue, and that's the one that we were talking about seeing a slight decline. And then we have U.S. equities, a positive value equals a long buy or a short cover. Okay, so as you're seeing these go down and you're seeing the short flows go down right here, we've just seen more and more aggressive short positionings and short flows into the market. Now, this is the first time this year where we have seen this large of a divergence. Was the selling too fast? And we're looking at the systematic positioning in U.S. equities, so basically the stock market, all right? And you have the CTAs, risk parity, volume controlled funds in blue, and then you have the actual SPX here. And you can see how, they kind of follow each other. All right. And many times when there's these big gaps in between them, such as over here, they end up closing, those gaps. So we're going to see if the S&P 500 is going to drop down towards these levels, or if this is actually going to start to tick up and maybe they were, selling a little bit too aggressively and too fast. And they're going to pump some of the brakes on that. Now, over the past 20 years, the S&P 500 has averaged gains of over 5% in Q4. Now, that may not seem like a lot, but when you think about the returns for a whole year on average for the S&P 500, 5% in Q4 alone is very significant. All right. And that's kind of the whole end of year rally that a lot of people are talking about. We'll have to see if that's going to happen or not. We're not necessarily following this trend here currently at the moment, as the S&P is continuing to make lows. It's possible we made our low in October 3rd, but if we come down and retest those lows, and we'll take a look at the S&P 500 chart here very soon. If we don't start making some higher lows and try to break this recent downtrend that we're in, then we could potentially keep heading lower. Margins are expected to improve for the second straight quarter in Q3. So essentially, that's what we're looking at right here. The S&P 500 quarterly net margins minus financials. So minus financial stocks here. And you can see these are the projections and the expectations here in yellow. All right. Now, pharma, biotech, and life sciences are the only industry group that analysts expect to experience operating margin contraction due to AI implementation. Everything else is likely, AI is likely to drive margin expansion for 24 out of 25 industry groups. Okay, now this is over the next 5 years. Obviously, tech and hardware, telecommunications, and semis being at the top here, but most notably, you have healthcare in there. They're expecting to see, some great improvements on margins for healthcare, for autos, consumer durables, financial services. Those are going to be all of the tops. Okay, now shortly behind there is going to be software. And even energy, they're expecting to see a nice boost in margins, with, again, only pharma, biotech, and life sciences, basically being the only one that they don't see AI likely to drive margin expansion for. Now, AI-driven revenue may increase significantly for some industry groups. The industry groups most likely to drive significant revenue growth from AI products and services over the next 5 years are financial services, with about a 41% increase. You have semis with 27% increase, tech hardware with a 26% increase, and software with an 18% increase. So, those are the top four. And then you're looking at household products with really no change at all. That's the only one where you're not going to see any change. Everything else is low to moderate, except for the four that we went over are going to be the highest. Now, this is the SPX daily downtrend. We've got a support level here right around 42.68 that we are bouncing off of. We bounced off of a little bit yesterday, but overall, the downtrend is still intact here, right? I mean, it's very clear to see we're making a high, then we're making a lower high, we're making a low, then we're making a lower low, and we're making a lower high. So we really need to put in a lower high. This is what I was mentioning here. We need to start putting in a lower high and then potentially putting in a higher high. Okay. That's what you're going to be looking for if you're bullish. Again, this is right around October 3rd is potentially when we may have bottomed. But if we break through this 42.68, it's very possible if we flip that to resistance, we're going to come back down lower. Now, our 200-day moving average is going to be roughly around 42.50. So, if we do end up breaking 42.68, pay attention to 42.50. Buyers typically tend to step in around the 200-day moving average. As you can see, we did here in the past. But if we lose that 200-day moving average, all right, 41.94, let's just call it 41.95. The market likes round numbers, is going to be the next support level to the downside that I'm paying attention to. Now, if we can start to put in a low here and start to rally and rebound, 43.40 is going to be your big overhead resistance level, and above there, 43.79. And this blue box here is a gap up to about 4,400 that, potentially we could fill. And that's where we could try to start putting in some higher highs. Even if it would just be a slightly higher high, it would still be nice to see that in the S&P 500. So those are kind of the main levels I'm looking at. We have TLT making new decade lows, breaking through $83. And, it seems like it just wants to continue heading lower. Again, I've talked about TLT coming down to that 82, 80, maybe even $78 price range, just based off of the simple structure that we're looking at. It's not as zoomed out, so you can't see everything, but we had our wave 3 down, and then we got an ABCDE wave 4. That was our triangle pattern where we saw price compression, and then we're getting that expansion with the 1, 2, 3, 4, 5 down. We didn't know how far up this wave 4 bounce was going to go. We wanted to see if it could get above $89.20. If it was able to do that, there were two gaps up that we were potentially targeting at 90 and right around $93. But unfortunately, it was not able to get up above 89.29 and stayed below there, and it's continuing to make new lows. It's very possible, some people could say that the bottom is in for TLT, but for me, I'm not really in that camp. It's not really showing any signs of a bottoming process. Okay, it's just continuing to, go lower at the moment, right? Same thing with the S&P 500. We haven't started a trend and changed the trend from a downtrend, right? We're still making lower highs here. We're still making lower lows. We really need to start making some higher highs and some higher lows here for us to see a potential bottoming process forming in TLT. Now, the 10-year is near 5%, okay? Right now, 4.89, 4.71, those are going to be the support levels to the downside I have for the 10-year, and overhead resistance is basically going to be 5%. It's going to be at 5.04 and 5.12. Those are the key levels that I'm looking at on the TNX, on the 10-year treasury. We have gold futures here. So gold futures, it says bearish below here. You can see we actually got a very bullish look below and fail. Now, this was largely in part due to, things have, geopolitics, let's just call it, okay? In the situation in the Middle East, you see we dipped down below here, and then we got our rally, and we're already back up here at our key level of 1984. And ultimately, this is kind of the structure that I was really looking for, right? I was looking for an ABC down, as you can see, and, looking for us, I think, ultimately to break through the highs. Now, this is going to take some time to play out and develop. And, if we were zoomed out even more, there's basically a triple top over here, right here, and right here. And, this supply is getting eaten up, right? And so the big question is, will we be able to break through this level the next time we test it? Up in that 2000 region for the gold futures. And in my opinion, I think it is very possible we can do that if we can get back up to those levels. The more times you test the level of resistance or, support, the weaker it's going to get. And so, being that we've tested this level, about 3 times and forming a triple top up there, I think that the likelihood we break through is, increased. It's not a guarantee, but it is increased. Now, we did talk about the potential buying signal right here. Okay, and how oversold the RSI was on the daily time frame. And we pointed out how each time that it was that oversold, you saw a sharp rebound. So what we need to be cautious of is, basically a sharp sell-off afterwards, right? We've gotten a very sharp rebound due to geopolitical reasons. Okay. And we just need to be cautious of something like this where it comes back down, right? And something like this where it rallies really hard and then comes back down. Okay. That's what you want to pay attention to, and basically be on the lookout for. That doesn't have to happen. But as I mentioned before in the past, each time we came down to those oversold levels on the daily, we saw a pretty strong rebound afterwards, and we did go ahead and get that in the gold futures. The US dollar has been still strong right now. It has started to pull back, some would say, but to me, it really just looks like it was consolidating, right? There's a key level here. We tested before, right? Resistance over here, then it became support, then it became resistance again, then it became resistance again. And I mentioned, the more times you test these levels, the weaker they're going to get. And so in my opinion, I thought that the US dollar was going to break out from these levels. And you can see very cleanly it did a breakout retest, and now it's just flagging a little bit, right? There's a small bull flag, you could say, right here. If the dollar breaks down below 106, 107, then I think it's possible we can come back down and retest 104.718 and above 106, 107. I've got 106.833 and 107.876 are going to be some overhead resistance levels. This does still have room to give back and still be healthy. It's above its 200-day moving average. So even if we broke below 104.78, all right, it's very possible it can come down to that 103 region, right around where the 200-day moving average would end up being. So, pay close attention to the dollar. The dollar is going to, move equity markets. It's going to move with the treasury yields. It's going to move with gold. So the dollar is something you do want to continue paying attention to right now. We'll have to see if the top is in on the dollar and if it's going to start falling again. That could be helpful for something like gold, right? Now, this is crude oil futures, all right? And crude oil futures still look really bullish at the moment. Of course, geopolitics again is helping that one out too. You can see prior resistance becomes new support. It was new support here, new support here. We put in that bottoming process, guys. So, this is what I mean by a bottoming process, right? You can see a topping process over here forming a top, and then we get the pullback. And this is what a bottoming process looks like, right? This looks very different than what TLT looks like at the moment. And you can see it hugged that 200-day moving average very nicely, started to find some support. Okay, we had a key level past resistance over here, resistance again, resistance again, resistance again, and then we break through, get a little bit of breakout, pullback, break through. We retested that zone. And so if crude oil futures can get above 89.36, then we can head up to 97.26 and 105.16. Those are going to be some of the key levels that I'm paying attention to the upside. And below 89.36, most likely it's going to consolidate, squeeze, and try and test that $80 level. If we lose that $80 level, look for a pullback and retest of the 200-day moving average. Now, that's pretty much it for today's video. Don't forget to sign up for that free newsletter giving out free trade ideas as well as free valuable finance content using the link in the description. All right. And if you want to, book a coaching session with me where you can figure out how we trade options and how we structure some of these trades, use that Ko-Fi platform using the link in the description as well. Click on the commissions tab, and through there, you can directly book a 30-minute or 1-hour session with me directly, and we can work on getting a time scheduled that works for both of us. Okay.